Hey everyone! Right now, BigBear.ai is getting hit hard in the mark, and if you just glance at the stock, you might think the story is falling apart. But here's the strange part. At the same time this company is struggling, it's also sitting on one of the fastest growing contract backlogs we've seen, jumping all the way to around $400 million. So the big question becomes, is the market overreacting to short-term pain? Or is this actually a warning sign that something deeper is broken? Because depending on that answer, this could either be a huge opportunity or a setup for even more downside. Before we go deeper, let's simplify what BigBear.ai actually is. This isn't just another random AI company trying to ride hype. BigBear operates in decision intelligence, basically using artificial intelligence to help organizations make smarter, faster, and more accurate decisions in complex situations. And we're not talking about small clients here. This company works closely with the U.S. government, especially defense-related departments, along with industries like logistics, manufacturing, and cybersecurity. So the idea is simple. As the world becomes more complicated and data becomes harder to interpret, BigBear is trying to turn that chaos into clarity using AI tools like predictive analytics and intelligence platforms. In theory, that's a very powerful position to be in, but in reality, things haven't played out so smoothly. Let's talk about what's really going wrong. Recently, BigBear's stock dropped below the $4 level. And yes, part of that came from broader market fears and geopolitical tensions. But here's the important detail. The stock was already struggling before that. The real damage started after disappointing earnings. Revenue didn't just slow down, it dropped sharply. In fact, for the full year, revenue declined significantly, and the company is still operating at a loss. And that's where investors started losing patience, because expectations were completely different. Investors were betting on one thing, the backlog. When a company's backlog grows, it usually signals future revenue growth. And in BigBear's case, that backlog exploded, reaching around $400 million after multiple contract wins. Naturally, people expected that growth to start showing up in actual revenue numbers. But instead, revenue moved in the opposite direction. And that disconnect is exactly what's shaking confidence right now. Because it raises a serious question: can this company actually convert those contracts into real income? Or is the backlog just potential that may take much longer to materialize? Now here's something a lot of people misunderstand. A backlog is not immediate revenue. It's basically a collection of signed agreements work that the company is expected to deliver in the future. Revenue only gets recorded when that work is actually completed. So when you hear 400 million backlog, it doesn't mean 400 million is coming in tomorrow. It means the opportunity is there, but execution is everything. And right now, the market isn't convinced. Now, to be fair, it's not all bad news. There are actually some strong positives here. For example, the company has significantly improved its financial position. It's sitting on a much stronger balance sheet, with hundreds of millions in cash and investments. On top of that, it reduced its debt by converting a large portion into equity, which lowers financial risk. That doesn't fix the revenue problem, but it does give the company time. And in this situation, time is extremely valuable. There's also a bigger growth story developing behind the scenes. BigBear has secured multiple long-term contracts, including work tied to major government programs. It's also building advanced AI systems designed to analyze global risks using public data and international sources. On top of that, the company is expanding through partnerships and acquisitions. One example is its move into border security and trade operations through international collaborations. And then there's another important piece: recurring revenue. Some of its newer platforms are expected to generate consistent income streams, which could stabilize the business over time. So when you zoom out, you can actually see a path forward. But again, it all comes down to execution. Now let's talk about the stock itself, because this is where sentiment becomes very clear. Right now, the stock is down heavily this year. But interestingly, if you look over a longer period, it hasn't been a straight collapse. This has been a highly volatile stock. Big moves up, big moves down. At one point, it traded above $9, and since then, it has trended lower, especially after earnings disappointment. What this tells us is simple. The markets had high expectations, and those expectations were not met. So now, instead of giving the company the benefit of the doubt, investors want proof. Now here's where things get even more interesting. Despite falling revenue, the company is still valued at a relatively high level compared to its sales. In simple terms, investors are still paying a premium for this business. And when a stock carries that kind of valuation, it usually means one thing. The market is expecting strong growth in the future, but after recent results, that expectation is being questioned, and that's why the stock feels unstable right now, because it's caught between two opposing forces: high expectations and weak current performance. Another thing you need to understand is volatility. This is not a slow-moving, stable stock. It moves aggressively both up and down. When momentum is positive, it can rise very quickly, but when confidence breaks, it can fall just as fast, and that's exactly what we're seeing right now. So now we come to the most important question: is this a buying opportunity, or is it a trap? Here's the honest answer. It depends on what you believe about execution. If you think the company can successfully turn its backlog into real revenue, then today's price might look attractive because the foundation is there: contracts, partnerships, and a stronger balance sheet. But if you're not confident in management's ability to deliver, then the risk is still very real, because without revenue growth, nothing else really matters. Going forward, the next phase of this story is actually very simple. Watch the revenue. That's it. If revenue starts growing again, confidence will return. And if that growth eventually leads to profitability, the stock could recover much faster than expected. But until that happens, the market will remain cautious. So here's the bottom line. BigBear.ai is not a dead story, but it's also not a proven success yet. It has a stronger financial positions, a rapidly growing backlog, and real opportunities in AI and government contracts. But at the same time, it has declining revenue, ongoing losses, and a credibility gap with investors. And until that gap is closed, this stock will remain under pressure. So the real question isn't whether the opportunity exists, it's whether the company can actually deliver on it. This is not finance advice.